Hi, everyone. My name is Fred Earnest, President and CEO of Vista Gold. I'm delighted to have this opportunity to visit with you about Vista Gold Corp. and our Mt Todd Gold Project, which we are positioning as a leading development opportunity with demonstrated feasibility in a Tier 1 jurisdiction. I will be making some forward-looking statements. I encourage you to become familiar with the cautionary language. Vista Gold is building value on the strengths of our Mt Todd Gold Project, where we have both technical and financial strength demonstrated through the feasibility study of a large-scale development plan. The study was completed at 50,000 tons per day, or 17.5 million tons per annum. Recently, we've completed an internal scoping study, which shows advantages to starting at a lower initial production rate with significantly lower initial capex. We are positioning Mt Todd as a leading development opportunity. And in the coming months, expect to announce the start of a feasibility study targeting 150 to 200,000 ounces of gold per year with an initial capex of less than $400 million US. I think it's important to note that we're exercising the discipline necessary to best realize value at the right time. Just want to give everyone a quick update on the feasibility study with regards to the large project that I mentioned. The study was originally completed in 2022. The economics were updated in the first quarter of this year, 2024, and take into consideration the inflation that we've seen over the last couple of years. As you'll note across the top of the slide, the project has 9.4 million ounces of total resource, with 7.8 million ounces of this reported as measured and indicated. The reserves are reported as 7 million ounces. And as designed, the production rate would be on average 479,000 ounces of gold per year over the first 7 years of the project, with an all-in sustaining cost over that same period of $961 an ounce. The feasibility study was completed at a gold price of $1,800 an ounce, which yielded a net present value at a 5% discount rate of $1.1 billion. If we look at the NPV at today's gold price, approximately $2,500 an ounce, the NPV 5 is $2.9 billion. You'll note on the right side of this slide, there's a map that shows the location of the project in the very northern part of the Northern Territory of Australia, which is a very mining-friendly jurisdiction. In addition to the resource and the reserve that I've already mentioned, we have exceptional opportunities for resource expansion from open extensions of the Batman deposit and adjacent mineral structures, as well as surrounding the mining license. We have almost 1,600 square kilometers of contiguous exploration licenses. In addition to the technical aspects of the project, we enjoy strong support from the local community and from the Jawoyn people, who are the surface owners. This next slide, this is what the project area looks like today. You see that it's a brownfield site. It operated in the 1990s. The deposit itself is located here below the Batman pit. It extends for 1.6 kilometers in strike length. The mineralized zone varies in width between 200 and 300 meters, and it's been drilled out to just a little over 600 meters in depth. You see that because it's a brownfield site, that we have some very significant existing infrastructure. What you can see is the tailings storage facility, which has 90 million tons of capacity, or roughly a third of the present reserve. Additionally, there's a water storage reservoir, which we will expand slightly to increase the storage capacity. What you don't see is that there's paved roads all the way to the site. There's a power line, which provides the power for all of our ongoing site management responsibilities. And there's a natural gas pipeline, which we plan to use to generate power on site at a cost that's about 30 to 35% of what we buy it from the grid today. Because this was an existing operation, the plant site will become the plant site for future operation. and this site requires very minimal civil work. I'd like to present 3 reasons why we believe that Vista's share price will increase in the near term. First of all, if we look at what's happened with share price performance over the last 2 years, you see in the chart on the right that the gold price is up 50%. Senior producers on average are up 87% over the same period. Developers, of which Vista Gold is one of many, have actually significantly underperformed, with many of our peers actually having performed negatively over the same 2-year period. You'll note that Vista is up 30% over this 2-year period. Now, we believe that there's a significant disconnect here, that developer valuations are lagging the gold price, and that with time, that share prices for developers as a sector will increase. Given the fact that our project is well advanced with a feasibility study, with permits, we believe that we will outperform. So this is the first point that we think will result in a higher gold or a higher share price. Second of all, if you look at the chart on this page, you'll see some data that was originally presented in the last several weeks by S&P Global Market Intelligence. They looked at the number of major gold discoveries over the last 35 years. We've summarized this data into groups grouped by decades. In the last decade of the 1900s, the period 1990 to 1999, there were 182 major gold discoveries, i.e., discoveries of gold projects that had more than 2 million ounces. In the first decade of this century, the number was approximately 120. In the period of time from 2010 to 2019, that number dropped to less than 50. And since 2020 to date, there's been only 5. We think that this means that with the gold industry producing almost 3,000 tons of gold per year, but replacing it at a rate that's far inferior to the rate of production, that at some point, producers are going to have to turn to projects like the Mt Todd project to replace depleting ounces. We believe that the benefits of shovel-ready projects like Mt Todd are demonstrated feasibility, lower risk, and a faster path to production. We believe that this will drive increased interest and increased valuations for developers with shovel-ready projects like Vista Gold with the Mt Todd project. Third, it is our view that we're in a strong and rising gold price environment, and we expect that we'll see continued strength in the gold price. The chart at the bottom of this slide shows that at the study price of $1,800 and using a 68-cent foreign exchange rate, which is slightly different than the feasibility study, that the present NPV of the project would be $1.2 billion at a $2,500 gold price, or in other words, at roughly today's gold price, the NPV5 of the project on an after-tax basis would be $2.9 billion. And at $3,000 an ounce gold, which we believe is possible, that the NPV5 of the project increases to $4 billion US. We think this demonstrates the very robust nature of the Mt Todd project and strongly suggests that in a sustained strong gold price environment, that the valuation for Vista Gold and the Mt Todd project should increase. We believe that all 3 of these arguments will ultimately drive the valuation of Vista Gold much higher and will benefit our shareholders. Now, I think it's important to note that we're committed to sustainable and socially responsible development. We have a tremendous track record in the Northern Territory with regards to our environmental management programs. We've successfully treated and released over 11 million cubic meters of acidic water that's been treated to neutral, and that metals have been released through our water management program, which has won awards both in the territory and nationally in Australia. All of the major permits for the project are approved: our EIS, our federal environmental authorization, and also our mining management plan, which would be the equivalent of a mine operating permit here in North America. On the social side of things, we place a very strong emphasis on safety. And to date, our team has achieved over 1,000 consecutive days without a lost time accident. We have a very strong relationship with the Jawoyn people who own all of the land in the surface in the area of the project with freehold title. And we work very closely with their corporation. And our relationship with them is underpinned by continual engagement. We also enjoy strong support across a very broad stakeholder base, locally and regionally. Like many companies, we're striving for very best practices with regards to corporate governance. On the exploration side of things, we have a tremendous exploration package, and all of our resources and reserves are located within a very small part of that. When you look at the map on the right-hand side, you see a red box. That's the boundaries of our mining license. That's where we're authorized to undertake the activities of developing a mining operation. That's where all of our resources and reserves are, all 9.4 million ounces of resources found there. And within that area, we've identified a number of targets which we believe have the potential to add another 1.8 to 3.5 million ounces to our resource base. Surrounding that, you see a land package that comprises almost 1,600 square kilometers, on which there are known occurrences of both precious and base metals. We undertake grassroots exploration activities on this land package on an annual basis and believe that with sustained significant exploration expenditures and drilling, that there's the possibility of discovering several new discoveries and developing resources which will further complement the Mt Todd project. To wrap things up, we are positioning Mt Todd as a leading Tier 1 development opportunity. We believe that Mt Todd is a large, high-quality gold project in one of the most attractive mining jurisdictions in the world. As I indicated, later this year, we'll be starting a feasibility study, which will target a project with throughput in the range of 4 to 6 million tons per year, something on the range of 12 to 17,000 tons per day. We believe that this project can be built with a capex of less than $400 million US. We're targeting production in the range of 150 to 200,000 ounces of gold per year. One of the things that we'll be doing in this feasibility study is that we'll be evaluating and implementing a higher cutoff grade. That will result in higher grades to the plant. It will result in a modest decrease in the reserves of the project. Presently, we report 280 million tons at 0.77 grams of gold per ton for 7 million ounces. We're targeting a cutoff grade somewhere in the range of 0.45 to 0.5 grams gold per ton, which will result in an ore grade or a deposit average grade of reserves of close to a gram per ton. That will result in a decrease to somewhere in the range of 5.5 to 6 million ounces of reserves. We believe that 5.5 to 6 million ounces of reserves with a grade of 1 gram per ton will be much more valuable in the market and much more appreciated than 7 million ounces at 0.77 grams per ton. Some of the things that we'll be implementing in this study, which will reduce risk, is contract mining. Previously, all of our studies have included owner-operated mining. We will continue to use third-party power generation, which has been a cornerstone of our previous studies. We believe that this study will retain a very attractive project economics, and we plan to retain the opportunity for expansion of the project at some point in time in the future. We believe that Mt Todd is especially attractive as a shovel-ready development opportunity, especially in the current environment where we have a strong gold market, diminishing major deposit discoveries, and ultimately depleting gold reserves across our industry. We're exercising the discipline to best realize value at the right time, and believe that both Vista Gold and our shareholders will be major beneficiaries of a sustained and rising strong gold market. So with that, I thank you for your interest in Vista Gold and would love to have you as shareholders at some point.
Thank you for a great presentation, Fred, and thank you for being here today.
Well, thank you for having me.
Could you introduce yourself and also walk us through your career?
Yeah, I'd be happy to do that. I grew up in a mining family. Went to the Colorado School of Mines and received a bachelor's science degree in mining engineering. Some of my first career opportunities were in underground mining operations, both on the construction side and on the actual operations side. When I graduated, I worked for a consulting company based here in Denver called Pincock, Allen and Holt, and had the opportunity to be associated with a great group of technical mining professionals. Had the opportunity to participate in the mine planning and evaluation of something on the order of 25 to 30 different projects over a couple of years, and then had an opportunity to jump to the operating side of the industry. And I took on the role of first mine engineer at an industrial minerals project, and within 8 months was named the mine superintendent at that operation. And under my tenure there, we were able to successfully transition the mine from an operation that was pretty much hand to mouth to developing mine plans that allowed us to get ahead on stripping, provide a wide blend of different products to the process plant. I then had the opportunity to go to South America, where I had the opportunity to transition to the gold industry, and that's been my home ever since. I first had the opportunity to be involved in the early stage planning of what is now Barrick's Pascua project. I worked for LAC Minerals at the time. Subsequently, I transitioned to become the construction manager for a project in the El Indio district, where we were building an open pit mine with a processing plant at about 4,000 meters in the Andes, and we successfully completed that construction project on time and just in time to be acquired by Barrick. And I then transitioned to a copper operation briefly in northern Chile, where I was part of a turnaround team that took a struggling operation and got it to the point that it was producing a nameplate number of cathodes. Interestingly, that project was owned by a gold company, and I then moved to Nevada to be part of their Nevada gold operations team. From there, I moved back to Chile and had the opportunity to take on the responsibilities of general manager of the Andacollo gold mine for a company in Minera Dayton, part of Dayton Mining Corp's holdings. And the year before my joining Dayton, that particular operation performed at about 62% of its design production capacity. Under my leadership, within a period of about 14 months, we were operating at nameplate throughput and production, and that was a very significant accomplishment. From there, this industry is known for mergers and acquisitions. We merged with a company called Pacific Rim, and I moved to Central America, to El Salvador, to spearhead Pacific Rim's activities in that country, trying to develop an underground low sulfidation epithermal vein system, which we got to the point of nearly having all of the permits when we became embroiled with in an expectation from the president of the country that he would receive some bribes. And at that point in time, I left the company and joined Vista Gold Corp. And I've been with Vista Gold since 2006. First as vice president of project development, and subsequently president and chief operating officer, and today as the president and CEO of the company, a position which I've held since 2012.
What would you consider to be your greatest achievements in your career so far?
Yeah, I look back with a great deal of pride on what we were able to accomplish when I was with Dayton Mining. from a couple of different perspectives. One taking over a project that was struggling operationally, both in the mine, the processing plant, just delivering gold ounces as projected, to be able to turn that around in just slightly over a year, to the point that we were exceeding plant throughput, mining much more efficiently, and ultimately producing the targeted number of ounces at a price below anticipated in a market where the gold price was dropping was a significant accomplishment. On the same time, the calendar year before my arrival, that particular operation had 8 lost time accidents, and within 2 years, we were able to reduce that to 0. At which point we began a 4-year run with no lost time accidents at that particular project. So it was I'm very proud of not only the production achievements, but also the cultural change that we achieved in the workforce in being able to adopt a safety-oriented and environmental protection-oriented mindset in the operation.
And how many shares do you hold of Vista, and how important is it to your net worth?
Well, today I own about 1.95 million shares of Vista, and my financial advisor would tell you that I'm overweight in Vista. It's an important part of my network.
And so, how have you built the management team and board at Vista?
So that's an interesting question, because as the CEO, I have a significant role to play in building the management team. And during my tenure as the CEO, I've been able to bring in some very, very qualified people. Doug Tobler, as our CFO, is a mining finance guy with an incredible amount of experience in raising money for the development of projects. Pam Sully has joined us as our Vice President of Investor Relations. We've recently hired a new Director of Projects and Technical Services, that following the retirement of our previous Senior Vice President. With regards to the board, it's a little bit different. I get a seat at the table, but I'm not the one who drives the board. But I've been able to manage a process where we've started to see board refreshment. We have 2 new directors this year. I expect that in the coming 2 or 3 years that we'll see a couple of additional new directors as others step off the board. And so we've been able to take the Vista board from a board that was pretty much the same board year after year after year to a board that is becoming more dynamic and changing and bringing in new points of view on a regular basis. And I'm very pleased with that.
So let's talk shareholders then. Your by far largest shareholder is the Sun Valley Gold Fund. How active is they in the steering of the company?
So I have regular conversations with Peter Palmetto. His viewpoints are well known and understood by both me and our board, but they take a more hands-off approach to management. They have no seats on the board of directors, and they expect the management and the board to manage the affairs of the company in the best interest of all shareholders.
Do you know what their intention is with regards to the shareholding in Vista?
Yeah, Sun Valley has been a very long-term and strong supporter of Vista Gold and the strategy that we've had of de-risking and advancing the Mt Todd Gold Project. I have no indications that support or their strategy with regards to Vista is changing.
You've been at Vista since 2006. Could you walk us through the history of Vista Gold and also how you got to where you are today?
Yeah, absolutely. In fact, if you don't mind, I'm going to step back just a little farther than that. Vista was first formed in 1983 as a company called Grandis. And Grandis started out as an exploration company based in Canada. In a not too long period of time, they acquired some assets in Nevada and became a producer, owning the Highcroft gold mine. And they owned a number of other exploration and different land packages. In 1996, they merged with a company called DeCapo Resources and brought some South American assets into the portfolio and changed the name of the company to Vista Gold. The development of the South American assets never really materialized. And in the late 1990s, with a decrease in gold price, Vista was forced to shut down the operations that they had. It was at that point that Rick Rule came to the management of Vista Gold at the time and proposed to them that this was not the time to be trying to be a producer, but rather that they should be an acquirer of ounces. And Rick indicated that if they were willing to pursue that strategy, that he would come to the table and help provide some of the financing. Ultimately, the board and management of Vista adopted that strategy, and from 2000 through 2006, the company grew the resource base of the company from roughly 2.1 million ounces to over 18 million ounces at an average acquisition cost of about 67 cents an ounce. In 2006, when I joined the company, we had just barely completed our last acquisition, which was the Mt Todd Gold Project. And we then began on a path of a series of transactions that actually began to monetize some of those holdings. In 2007, we spun out all of our Nevada assets into a company that was named Allied Nevada Gold Corp, and we dividended those shares out to our shareholders, and that was an incredibly accretive transaction for our shareholders. In 2011, we helped create another gold mining company, which was called Midas Gold Corp. We had acquired part of the Stibnite district, the Yellow Pine deposit, and we used that to consolidate that district. Today, Midas is called Perpetua Resources, and obviously those people who followed that transaction realized that that was another accretive transaction for the company. We sold a number of projects in Mexico. We allowed ourselves to get diluted down on a project in Indonesia to a royalty and ultimately sold that royalty. But through all of this, starting in 2007, we have been advancing the Mt Todd project. Originally, we began drilling, and to date, we've drilled over 65,000 meters of core drilling at Mt Todd. But we tripled the resource. Originally, it was 3.2 million ounces. Today, it's 9.4 million ounces with 7 million ounces of reserves. We began addressing some of the operational problems that we identified in our due diligence of Mt Todd. We've conducted an immense amount of work on that's allowed us to develop a process flow sheet. 2013, we published our first pre-feasibility study for Mt Todd. And then the gold price dropped. And so we went back to the drawing board and we did some more work on the process flow sheet, more testing. We subsequently adopted ore sorting into the flow sheet. We had adopted 2 stages of grinding. This allowed us to efficiently grind to a finer grind size, 40 microns down from 100 microns. That resulted in an increase in the gold recovery from roughly 82% to 92%. And then we published another preliminary feasibility study in 2019. 2022, we published our first feasibility study on the project. And as I mentioned previously, we updated that feasibility study the first quarter of this year with current costs on both the capital and operating cost side. That's kind of the Vista story and how we got to the point that we're the owners of one of the most significant undeveloped gold projects in Australia.
Thank you for being here today, Doug.
Hey, no problem. Thanks for having me.
Could you introduce yourself and also walk us through your career?
Oh, sure. So I'm Doug Tobler. I'm Vista Gold's CFO. I've been with the company for just over 5 years at this point in time. Now, if you roll the clock back, I'm a Denver native, born and raised in the Denver area, went to the University of Colorado, did the typical, came out with an accounting degree and went to work in public accounting. For me, it was a very good experience. It's obviously a difficult profession, but during my time there, I emphasized energy and natural resources, specifically mining clients. So that really gave me my spark to continue on once I left public accounting in the mining sector. I also spent a year in their national office in New York City. They called it their accounting and SEC directorate. So I got a good exposure to not only accounting issues, but how the SEC operated, which is relevant to Vista Gold since we're a U.S. listed company. After I left public accounting, I continued to pursue the mining sector. So I joined an exploration company, a little junior explorer, and we were looking largely for copper and then some gold deposits in South America. We focused in Chile, but we also had a little bit of activity in Bolivia and Peru. So that gave me a good experience to that front end side of the mining sector. I can say that through that process, the company, not me, but the geologist, discovered two projects, both in Chile. They're both large copper projects. And at least one of them, I think, is now advancing towards a development. So that was a very good experience. From there, I moved up a little bit to a company that was maybe a little bit closer to development. And that company had an active project, had a number of projects, some exploration, but some with small resources in Turkey. And the best of those opportunities was a gold project, and it had a handful of holes, a very small resource. So through the course of my time there, we raised the funding to finish drilling out the deposit. We raised the development money, which included money to do feasibility study and build out the organization, and then the construction funding. And that project went into operation, I think, in 2010. Shortly after going into operation, we did a merger with an Australian company. So the combined company at the time had a $2 billion market cap. And we had 3 operating mines, and we had a non-operating position in a 4th mine. So that was an exceptionally good experience, very broad-based. We also had several 100,000 hectares of exploration property spread across Western Australia and Turkey. So it was quite an interesting organization. That led to my next venture. I took my skill sets as a CFO and jumped to a company that was active in Armenia, just next door to Turkey, but obviously quite different from a social and overall societal arrangement from what you had in Turkey. Did very similar things there. The project was a little bit more advanced when I got there. We still had to do a feasibility study, but then we pushed through the financing. It was a very complicated structure. It included equity and debt from 2 large private equity groups. It included financing from the equipment provider, the mining equipment provider, as well as export credit money from a couple of different organizations. So very complicated financing on that project. And then, of course, the same thing where you have to build out the organizational capacity, going from being an explorer, early stage developer, all the way into what it takes to become a producer. So that involved people and systems largely. That led to where I'm at today, which is at Vista Gold.
How many shares do you hold of Vista, and how important is it to your net worth?
Vista on a subjective basis is exceptionally important, but my holdings are just shy of 350,000 shares. And in terms of its importance to my portfolio, it's a large percentage, but the Vista Holdings itself is the single largest position that I have within my portfolio. So I keep a very close eye on it and keep it close to my heart.
Could you give us an overview of the capital structure with regards to shares outstanding, options, RSUs, warrants, etc.?
Sure. So first off, Vista doesn't have any debt on its books, which is really helpful to not have to deal with debt service or shares going out the door to pay interest, which you're seeing as a more common scenario. So we've stayed away from that. From a structure standpoint, our issued and outstanding share count is 122.5 million shares. And then after that, there's only one small 50,000 tranche of options. It's out to a service provider that we used a number of years ago. They'll probably expire next year. But the big chunk of things that lead us to our fully diluted number is the restricted stock units that are available for the management team and the deferred stock units that are available for members of our board of directors. And that adds up to a collective total of an additional 4.6 million. So it's a pretty tight capital structure.
I mean, you have $20 million in cash. What's the working capital position like?
Working capital tracks pretty close to our cash position because you would add in your other current assets, which we always have a few things like prepaid insurance and that. And then that largely offsets our payables. Plus we keep current with our vendors, so we don't have any long outstanding accounts payable. And to put it in perspective, at June 30th, our cash was 20.2 million. Our working capital was 19.7 million.
What's the quarterly G&A burn rate on average?
Yeah, so we've been able to hold our burn rate relatively steady for the last 3 years, and it runs right at $1.5 million per quarter. Now, what we cover with that is all of our corporate costs, so the Denver-based office, and then also all of our site-related costs, our recurring site maintenance costs. And it's about a 60-40 split. 60% is the corporate cost, the other 40% is at site.
The phase 2 of the drilling program, how much is that estimated to cost all in?
Yeah, so to put it in perspective, it'll be 6,000 to 7,000 meters. We're within about 6, maybe 8 weeks of being wrapped up with that program. And our all-in cost is about US $300 per meter. So that's the drilling cost, the assaying cost, and all the other ancillary costs, fuel and the like. And so at 300 a meter, we'll be right at $2 million.
$2 million that is left to spend, or?
No, $2 million total. For the 6,000 meters will be about $2 million.
Okay, so, and as you already more or less were finished with, had done most of phase 1 in Q2, by Q2, we should have 1 million or a little bit more maybe to spend.
Oh, yeah, we're probably down to where we've only got about $500,000 left to go on the program. We're well over 3/4 of the way through the program at this point.
Perfect. So then I think what everyone is wondering then, your 20 million, how far will that get you in terms of advancing Mt Todd?
Yeah, so obviously the drilling is fully funded. The next thing that we'll do after that is launch ourselves into the feasibility study. And again, the target there is 150 to 200,000 ounces per year scenario with Mt Todd. And that'll take us out through the middle of next year. So when we get that study done, we will have spent maybe another $1.5 million specifically on that project, plus the run rate that I described of $1.5 million per quarter. And when we reach that finish line with the feasibility study, we'll still have several quarters of cash available in the bank. So well through the end of 2025.
And then, so at the end of last year, I mean, the reason why I got 20 million is because he sold at 1% gross revenue royalty to Wheaton Precious Metals. Could you explain the terms of the royalty deal and also how it came about?
Yeah. So, just a little background on how it came about. We've known the Wheaton people for a number of years, both Fred and I, through our different organizations. And, we first met with them about 1.5 years ago now. And, they showed a very early interest. We were talking about potentially a stream at the time, but, they directed us towards a royalty because at an early stage, getting into a stream is really a means of an offtake agreement for the metal. So the royalty really made sense for the stage of development that we were at the time. And over the course of a number of months, we looked at term sheet from them. We were looking at opportunities from other organizations. And then about 1 year ago, we had gotten them to site. They did an incredible amount of due diligence on the project, both in terms of things that were available in a data room, plus boots on the ground. And then the structuring took several months to get done. A royalty in Australia is a little bit different than a royalty in the US and Canada, where it runs with the land. You have to create, certain legal agreements, security interests, things like that. So we worked through all of that, got the deal closed in December of 2023. And the way the funding worked is we had 3 hurdles to jump. The first was closing, which we did, and that funded us $3 million. And the importance of that was that let us start drilling just as quick as we could get boots on the ground, get the drills up and running. And that happened in late January. So that $3 million was very instrumental to starting the drilling when we wanted to. The next tranche was $7 million, and that came in February once we had completed all of the security documents. That gave them the assurance that we were, in business, they were in business. And then the final $10 million came in 6 months later, and the one condition was we had to have started the drilling, which of course we had already done 5 months previously. So in terms of the actual terms of the agreement, you described it, it's 1% for the $20 million. There's a couple of features within the agreement. They've got the benefit of, we've got encouragement to get the project going, up and running, producing gold, because that's when they get paid. But then there's also a trigger when we hit 3.5 million ounces of produced gold, then the royalty steps down by 1/3. So that's a nice thing because it doesn't burden the asset for the full life of the production.
So then what royalties are there on Mt Todd?
Okay, so obviously the Wheaton royalty, that's 1%. We've also got 2 royalties with the Jawoyn Aboriginal people. And they're the traditional owners of the land where our mining licenses and exploration licenses sit. in what the 1% royalty does with them, it allows us surface rights access to the project. That royalty has been in place back to when we first entered Mt Todd. Then more recently, in 2020, they had a second piece, which was a right to be a 10% participating partner in the project. And over the course of years, what they realized is that meant they would have to raise money, deal with debt schedules, deal with, management committees and the like. And we concluded on both sides that it was better to convert that right to a participating interest into just a royalty. So we created a sliding scale royalty. And that royalty is 1/8% when gold prices are low, and it's up to 2% when gold prices are high. So what does that mean? Well, the low end of the scale is gold price of $1,250. And the high end of the scale, when you hit 2%, is anything at above $1,450. So when you sit here today, we're at the full 2%. And that's designed so that when gold prices are high, we share the gain. And if times get tough and gold goes down, then we all share the pain a little bit. So I think it's a good structure for both companies. So in summary, Wheaton 1%, Jawoyn any 1% plus the sliding scale.
So in other words, 4% is what we're looking at.
Today it would be 4%, yes.
The royalty regime in Northern Territory was actually changed early this year from 7% to 3.5%, more or less. So at the $2,500 an ounce gold where we are today, what impact does that have on the NPV of the project ballpark?
Yeah, that's a great question. The former royalty structure that was replaced effective July 1st of this year was very complicated. It actually, it equated to a 7% gross royalty, but it included a minimum requirement plus a potential additional amount based on what your net profit was. And one of the things that means is when gold prices go up, that structure is much more punitive than just a flat royalty based on gross revenue. And to put that in context, when you adjust our gold price from $1,800 that we used and which generated the 7% you spoke of, when you bump the gold price up to $2,500, that Northern Territory royalty actually looks more like 10%. So extremely punitive. What does that mean in terms of the project? Now that it's 3.5% of gross revenue, it reduces the royalty by $1 billion on a pre-tax basis. If you run that through the NPV5 calculation after taxes, it's $400 million. So it's a very significant adjustment by the government.
Interesting. What prompted that?
Yeah. Well, I think you have to recognize that the Northern Territory has a very large footprint in terms of the overall scale of the country, but it's got a relatively small population. They've got a okay agricultural business, an up-and-coming natural gas business, and then there's a few good operating mines in the territory. And what drove this is the government officials started looking at their growth plans, economic development plans for the balance of this decade. And what they realized is the real opportunity lied in the mining sector. So 2 years ago, they formed a task force, and the task force had the objective of how do we incentivize miners to come to the territory, spend exploration dollars, and ultimately build mines that pay a royalty. And the task force came back with a number of recommendations. It's a 70-odd page report, but the real headline thing that they realized they needed to do was become competitive on the royalty. So by way of example, Western Australia has a gross royalty of 2.5%. So when you're talking 7% or 10%, just not competitive. People can't afford to come in and build mines. So the real headline was get the royalty rate down to where they could be competitive with places like Western Australia, like Nevada in the US, British Columbia in Canada. And they're kind of right in the middle of that collective group at this point in time. So bottom line is they had a couple of big royalty payers, but they were really dependent upon those couple of big operations. They wanted to diversify their revenue base, and in doing so, they can drop the royalty rate and still keep their revenue base intact.
I think it first would be good if you could give us an example of one or a few other mines that are operating in the Northern Territory.
Yeah, the Northern Territory is a very mining-friendly jurisdiction. we've enjoyed great support from both the previous Labor government and the current Conservative government, with having just been through a change in government in the last 6 weeks. The territory has a rich mining tradition. You asked about producing operations. Perhaps two of the more notable and more significant mining operations in the territory right now are Newmont's Granites project, or also known as the Tanami Gold project. And another one would be Glencore's McArthur River lead zinc operation. The Tanami project is located in the kind of western central Northern Territory, within probably 100 kilometers of the Western Australia border. The Glencore project is up on the northern side of the territory on the eastern boundary. Closer to us, a project that's not operating at the present time would be the Cosmos Union Reefs operation, which is presently owned by Agnico Eagle. That particular gold project is about 40 kilometers from the Mt Todd Gold Project, and located broadly within the same mining district, where both projects, Mt Todd and Cosmos, are located within the Pine Creek district, which has been a gold producer for over 100 years.
Could you explain the geologic setting in which Mt Todd sits?
Yeah, so the Mt Todd Gold Project is a sheeted vein system. The host for the deposit is a silicified package of siltstone, shales, and greywack. These very fine-grained sedimentary rocks that, in the tensional environment associated with the formation of what we call the Pine Creek geosyncline, this rock was shattered and subsequently filled with veins, and over two different mineralizing events millions of years apart. The first saw gold come into the system in fracture filling with quartz, calcite, and sulfide veining. And the subsequent event was just quartz veining with gold in the quartz. These sheeted vein systems, like we see at Mt Todd, we see something on the order of, I think, we might say 7 to 20 veins per meter. Some of them are width of only a millimeter. Some of them are bigger than 10 centimeters in width. And the gold is associated with either the quartz or with the sulfides and the quartz in the first event. This rock is the mineralized zone is very large. The deposit that we consider to be the Batman deposit has continuous mineralization over 1.6 kilometers of strike length. The mineralized zone varies in width between 200 and 300 meters, and has been drilled out and demonstrated to be continuous down to below 600 meters in depth. So this is a very, very large deposit. The reserves for the deposit are reported to be 280 million tons at 0.77 grams of gold per ton. Now there are some other minerals, but they're very, very low grade. We see about a gram per ton of silver. Most of it is in a form that's pretty hard to leach, and we don't even include silver in our cash flows. There's also some copper, around 400 ppm. Not of any concentration that would allow us to recover it. We see minor amounts of lead and zinc as well.
You're currently drilling. What questions are you trying to answer with this year's drilling program?
Yeah, so we've completed phase one, and phase one of the drilling program consisted of about 3,000 meters of drilling at the very north end of the Batman deposit. We know that the higher grade core of the deposit kind of trends are upward toward the north, and we have much of the drilling at the northern end of the deposit is historic RC drilling, drilled by Pegasus and others. And so we drilled a number of core holes through the northern couple of hundred meters of the deposit to identify and confirm the boundaries of the mineralized zone. Typically, in the past, we've seen upgrades in grades when we replace RC drilling with core drilling. We've seen some of that, in some instances, not so much. Some of our holes have intercepted mineralized material in areas where we had no previous drill holes indicating that there was mineralization. So it's been phase one, I think, was accomplish our objectives of defining more closely the limits of the mineralized structure at the north end of the deposit. We've encountered mineralization in areas where it was unknown, and we've confirmed what the style of mineralization is, that there's really no changes compared to what we see in the rest of the Batman deposit. And then phase two, the drilling that we're doing right now, is drilling an Oreshoot, or a structure that we call the South Crosslode. I mentioned that the Batman deposit is 200 to 300 meters in width. The South Crosslode is very small in comparison. The mineralized zone that we're targeting is about 40 meters in width, and it projects as a shoot offwards to the northeast from the Batman deposit. What we've seen so far in this drilling is that we're farther away from the heat source, being the Yinberry Hills that are to the west of the Batman deposit, and was we believe the source for the fluids that created the mineralization at Mt Todd. The sediments are coarser grained; they're not as silicified, and we're seeing vein intercepts that are wider than what we see typically in the Batman deposit. And that was suggested in some of the early RC drilling results that identified this Oreshoot. We're preparing to announce results in the next, say 4 weeks or so, perhaps sooner. And we'll talk more about those results at that point in time. But right now we're seeing fewer veins, but wider veins, which is a different style of mineralization, and our geologists are busy trying to tie this all together over about 400 meters of strike length. So it's the phase two program is actually pretty interesting and exciting for us.
How many meters are you drilling in phase two?
We're going to drill another 3,000 meters in the second phase of the program, and perhaps just a little bit more at the tail end. Right now we're about 2,700 meters into that program.
This lode or Oreshoot, is that outside? I mean, how far away is that from the Batman pit?
Well, it actually starts inside the Batman pit and then projects out of it to the northeast. So some of what we're drilling is inside the boundaries of the pit and currently classified as waste. And some of it is outside the limits of the pit, projecting to the northeast.
Yeah, I mean, I guess we have to wait to receive the results. But will this be brought into the mine plan if it's successful?
Well, we believe that some of it will. I mean, some of it is already inside the mine plan, and so if we're successful in converting, this narrow chute, if we could call it that, to either to indicated resource, then it would become classified as reserves within the pit boundary. Whether it will change the mine plan at all going to the northeast or not is something that we'll have to wait and see once we see the model. I really don't have a feel for whether it will change it or not.
You already have a very large resource, 280 million tons of proven and probable reserves. And sure, you will increase the cutoff, so it will go down, but still, it's still a very sizable resource. What impact do you ultimately think that this year's drilling will have on the size and also, most importantly, on the grade of the resource?
I think that the best guidance I could give is that, given that the drilling at the north end of the deposit really only affected about 15% of the total tons in the resource, and that generally what we did was confirm and perhaps added some ounces. I think that the changes will be very modest. And then when we think about the phase two drilling, where we're drilling something that's only 40 meters in width and over a 400 meter strike length, even if all of it were to come into a mine plan, the relative number of tons is quite small compared to the 280 million. And so I think that I would caution people to say that the new resource estimate, we'll see some very, very minor changes.
But then why did Wheaton advocate for this drilling program if it really won't change the overall resource?
Well, that's the thing about exploration. You never know what the answer is going to be until you put the holes in the ground. And one of the Wheaton, typically the way they set up royalties, and you have to understand that Wheaton's business is not royalties, it's really streaming. And that by giving us a royalty, they got their foot in the door. But typically payments are staged, and there needs to be some level of commitment or accomplishment with the initial funds that are advanced to get the latter funds. And we agreed that the start of a drilling program, not results of a drilling program, but the start of a drilling program where we're putting some of that money to work in the ground would be an acceptable use of proceeds. And so just being able to, we were targeting as much as 500,000 ounce increase in resource at the north end of the deposit. I don't think that that's going to be the case, having seen the results, but that's the nature of exploration. You don't know what you're going to find until you drill the holes. So I think that they're keenly interested in the project. They did an immense amount of due diligence on Mt Todd before they agreed to the royalty that we have. And the upside of these things is that until you drill the hole, you never know exactly what you're going to hit, and sometimes things turn out much better than you expected. In this case, it seems that we've confirmed what we had before.
Could you give us an update on the grassroots exploration activities that you're doing in the background?
Yeah, so as I mentioned, we have 1,600 square kilometers of exploration licenses, and they cover 2 structural corridors, the Batman Driffield structural corridor, which the Batman deposit anchors the southwest end of, and then the Driffield Cullen Driffield or Cullen Australis structural corridor across the northern part of the exploration licenses. There's already been a considerable amount of work. Our team goes out and collects soil samples, does mapping. You can imagine that 1,600 square kilometers is a lot of ground to cover. And as we see new things from the mapping, we go in and do soil sampling on a regular grid and sometimes follow that up. And so those activities are ongoing. I think it's important to note that the exploration licenses are already the known hosts to a number of gold occurrences that we've identified, as well as base and precious, as well as base metals, in addition to the precious metals. So right now, this year's work is soil sampling and mapping. We're participating with the government on some expansion of some geophysical surveys, and we'll be very anxious to get those results back. Understanding the geophysics will give us an idea of where some of the magnetic highs and lows are, which certainly gives us an idea of what might be the historic heat sources for mineralization in the district. So that's some of the ongoing.
Awesome. Thank you for that update. So then if we move to Mt Todd, so I think it would be good to set the stage here, and if you could give everyone an overview of the current Mt Todd operation. I mean, as per the most recent feasibility study, mining, how do you mine it, how do you process it, what's the metallurgical type, and also cost structure.
So as we mentioned, this is a sheeted vein system, and the deposit is massive. At 1.6 kilometers in length, and 200 to 300 meters in width, the depth down to 600 meters, with an average grade of 0.77 grams per ton. This will be an open pit operation. It'll be a very large open pit operation, and the mining side is very straightforward. This will be very conventional, drill and blast and load and haul. We'll be using a combination of front shovels and front end loaders to load haul trucks and transport ore to either the crushing plant, the low grade stockpile, or the waste rock dump. On the processing side, this is a very conventional gold processing flow sheet. We've done a lot of work looking at and evaluating, designing the comminution circuit. We've adopted 3 stages of crushing. The first stage will be similar equipment, although much larger than what was used at the the original Mt Todd operation, i.e. we'll have a gyratory crusher. That will feed a couple of secondary cone crushers. That technology was also proven and demonstrated in the previous operation. From there, the ore will go to high-pressure grinding roll crushers. And this is technology that we've done an immense amount of work studying and evaluating. In fact, I believe to date we've sent more rock to ThyssenKrupp Polesius, this test facility in Germany, than any other mining company. And part of that has just been we want to make sure that we understand how this rock behaves in those crushers. And we're very satisfied. We believe that this is the right technology. Now, of note, since we first started looking at these crushers, companies like Newmont at the Boddington operation and subsequently Newcrest at Cadia and Anglo Platinum at a platinum mine in South Africa have all implemented and installed and are using the size of HPGR crushers that we intend to use at Mt Todd, all with very, very acceptable results. And so we're very confident that our comminution circuit is solid and has been designed appropriately. From the third stage of crushing, we actually screen at a couple of different sizes, and we take the oversized material and we'll send it to an ore sorting circuit where we will separate material based on the presence of either sulfide minerals, which are known to be associated with gold, or the presence of quartz minerals, which we know the quartz is a host to the gold. And those minerals will return to the crushing circuit. The rock that doesn't have either sulfide minerals or quartz on it will be rejected from the circuit. And right now, the test work done with TOMRA sorting solutions in Germany suggests that we'll be able to reject about 10% of the run-of-mine material from the circuit. That obviously reduces the amount of material that we have to crush and grind. And given that this material is harder than any other, it saves us costs in the subsequent grinding circuit. From the third, once the material reaches final product size in the crushing circuit, it goes to a bank of cyclones, which are really just a size classification tool equipment that in a slurry is able to separate material into two fractions. In our case, we're going to separate a coarse fraction, which will go to the ball mills, and the fine fraction will go to the fine grinding circuit. The material from the ball mills will ultimately report to the fine grinding circuit, and ultimately we will produce a product that is 40 microns in size. We, like many other gold projects, have learned that the finer we're able to efficiently grind, the better gold recovery we get. And previously, when we just had ball mills and single stage grinding, our gold recoveries were estimated to be 82%. Today, with two stages of grinding and being able to achieve a grind size of 40 microns, our gold recoveries are estimated to be 92% over the life of the project. So there's a very significant improvement in recovery. From there, the ground material will go to a very conventional cyanide recovery circuit. We'll have pretreatment, carbon in pulp, where we'll leach the material with cyanide, absorb it onto carbon. Then the carbon will be separated, and ultimately we will recover the gold off of the carbon, electrowin it, recover it out of the electrowinning cells, and produce gold doré, which right now the estimates are that it'll grade out somewhere in the 80 to 85% gold range. So this is a very, very conventional gold recovery circuit, something that you would see in Western Australia, in Nevada, gold mines in South America. It's a flow sheet that's used globally.
And on the cost side,
yeah, for the feasibility study at 50,000 tons per day estimates, this becomes a project much like Detour Lake or Boddington or Cadia, where this is a bulk materials handling project. And as such, we're able to take advantage of some very significant economies of scale. And we estimate that our all-in sustaining cost will be at the scale of 50,000 tons a day and producing on average, 479,000 amounts of gold per year will be below $1,000 an ounce.
You published the feasibility study earlier this year. What was the reaction and feedback from producers to the updated feasibility study?
That's an interesting question because obviously people applauded Vista for having the courage to update its numbers. I think there's been a great deal of fear in the market as to what the ultimate impact of inflation has been on projects. We've always been confident that the project was robust, and at the time we completed the study, it merited a very modest increase in the gold price we used for economics. We used an $1,800 gold price, and obviously today that looks very conservative when we're looking at a spot price of nearly $2,500 an ounce. Unfortunately, we find ourselves in a market where senior producers are interested in replacing their depleting resources and maintaining their production profile by acquiring other producers. A good example would be the recent merger or acquisition by Newmont of Newcrest Mining, and here just in the last week, AngloGold Ashanti announced that they're acquiring Cinnamon, and that seems to be the flavor of the day. So while there was general congratulations for having updated the feasibility study and updating the costs with current numbers, there's not really been much interest in developing stage projects, ours nor anybody else's, and that's just kind of industry wide right now. So, we got favorable comments for completing a study and updating economics. It didn't generate any additional interest in leading to a partnering arrangement.
So given that, it's understandable why you choose to revamp the project, make it smaller, higher IRR, etc., lower capex. But so, what's the timeline, firstly, for releasing or doing and also releasing the new feasibility study with the stage approach?
Yeah, so given the fact that we've already completed an immense amount of technical work, the flow sheet is not changing. Those things are going to remain static. So we believe that launching a feasibility study with targeted throughput in the range of 4 to 6 million tons per annum, 12 to 17,000 tons a day, gold production in the range of 150 to 200,000 ounces of gold per year, that starting the study late this year, that we'll be able to have it completed by the middle of the year next year. We're targeting the end of June.
Okay, so middle of next year is the time for release. And by the way, could you clarify, are you planning on doing a phased approach with sort of 4 to 6 million tons per annum for the first couple of years, followed by an expansion, or is that just it?
Well, everything's on the table right now, Jasper. The initial mine plans will be developed on a standalone basis, and that will be the basis for looking at what might be optimal times for project expansion. There is some ongoing work looking at what optimal expansion sizes and timings might be. Whether or not we include expansion in the feasibility study or not is a factor yet to be determined. But regardless of that outcome, the project will be designed with the idea that it will ultimately at some point be expanded. We believe that ultimately the economics of the project, the value of the project, are much greater if there is an expansion. But on the other hand, we're hearing the feedback from many, many points that a gold mine that produces 150 to 200,000 ounces of gold per year is a very respectable gold mine. And so, there's kind of two thoughts on how you approach expansions. One might be, an example might be Artemis, where they have come out and said, we're going to develop the project in this manner. We're going to build phase 1, and then we're going to have phase 2, and we're going to expand it at year, whatever that is, 6. And then in year 9, we're going to expand it again. And here's the cost, and this is the way it's all going to play out. And then on the other end of the spectrum, you have companies like Capricorn Metals in Australia who said, we're going to build a mine and we're going to target 120,000 ounces of gold per year. And we're going to build it and we're going to get it running the way it's supposed to, and we're going to deliver the goods. And today, on the back of that one gold mine, they have a market cap of almost $2 billion Australian. And it's only recently, in the last couple of weeks, maybe a month, that they've announced that they're going to undertake a study to evaluate the potential of expanding that operation. And so there's merits on both sides of this argument, and we haven't decided where we come down.
How do you expect the strip ratio to change with a smaller scenario?
Well, so the strip ratio will be driven by a couple of factors. One is we're going to raise the cutoff grade. As I've indicated, the present reserve is 280 million tons at 0.77 grams of gold per ton. We're going to raise the cutoff grade from 0.35 grams per ton today to something I expect in the range of 0.45 to 0.5 grams per ton. What that will do is it will increase the grade of the reserve. We're targeting something closer to a gram per ton. It will decrease the reserves, obviously. And depending on the gold price we use and the mine plans, the strip ratio could change from presently it's 2.5 to 1 life of mine. Ultimately, the strip ratio could be perhaps something in the range of 3 to 3.5 to 1 in a smaller scenario.
So you said the flow sheet won't change. Should we expect any changes in the recovery rates, which currently sits around 92%?
No, the flow sheet will be exactly the same flow sheet. We expect no changes in the recovery, given that the grind size will be exactly the same.
Perfect. But then, so all-in sustaining cost, what changes should we be expecting that?
Until we get the study completed, it's hard to say exactly what the all-in sustaining cost will be. But given the fact that we're going to be a smaller operation, we're going to not have the same economies of scale that we have at 50,000 tons a day. We will have contract mining. There will be some drivers on the operating cost side that suggest that the all-in sustaining costs will be higher. If I had to provide guidance today, I would suggest that our all-in sustaining costs will likely be in the range of perhaps $1,150 on the low side to $1,250 on the high side, roughly half the gold price today, and which still is a very respectable all-in sustaining cost. It's in line with what the average is for the senior producers.
I mean, you say lower than 400 million US of initial capex. Could you give us a ballpark interval? I mean, a rough ballpark interval of where you expect to land.
Well, until the design work is completed, I don't know what the exact capex is going to be. We've indicated that we're targeting less than 400 million. I think reasonably we'll be in the range of 350 to 400 million, although we'll be striving to be lower than that low end. But I don't know if we can get there.
Okay, but that's a good point.
I can comment, that there's been some feasibility studies announced by Australian mining companies in Western Australia in Aussie dollars that lead us to be very, very optimistic that is achievable. Now, certainly some of the projects that are publishing feasibility study numbers are, they're softer ore, and they don't have to do some of the things that we need to do at Mt Todd, but still. Just given the results of other people's studies, I think that we're generally optimistic that we can achieve an all-in initial capex in the range that we've just discussed.
When you ultimately decide the production profile, throughput, etc., I mean, do you have a target IRR or a target payback period or MPV5, or could you sort of give us an overview of your thinking?
It's early for that. I mean, there's a trade-off study in progress right now that's going to narrow down the ultimate throughput size, whether that's 4 to 5 or 6 million tons per annum. That will have an impact. It will drive some of the equipment selection. As far as what are our targets? And again, it depends on gold price that we use, things like that. But our feeling is that what we see in the present feasibility study, at a very conservative gold price of $1,800, the the IRR is in the range of 20%. And if we look at a gold price like we have today, it's above 30. And I think that the smaller case will see very similar economics. When we think about IRRs, what we've seen in the previous studies, depending on gold price. So, I think that's as far as I would feel comfortable going at this point without having the study commenced and having seen some of the preliminary indications.
Say that we have a gold price. Say that you assume $2,300 per ounce of gold. Would you like to give us a rough ballpark range of what the MP5 could look like?
Like I said, it's hard to say, but if we were to put a number to it, I'd say that in a smaller project with a much smaller capex, we're probably looking at something in the range of $1.1 to $1.4 billion at that gold price.
In which area, do you see most risk with the project?
I get asked that question a lot. And, we've had the Mt Todd Gold project since 2006. We've spent an immense amount of money drilling, modeling. We've been through the process of signing confidentiality agreements with no less than a dozen different companies who have taken a look at Mt Todd over the last 30 months. We've had the resource model redone, validated by several of those companies. We've had companies spend their own money on drilling and subsequent metallurgical test work. We've had the process flow sheet reviewed by our own third-party consultants. I don't see a lot of risk on the resource or on the metallurgy side. The fact that we have the permits in place for the project, I don't see much risk on the permitting side. We already have the EIS, the Federal Environmental Authorization. Our mining management plan is approved. We enjoy a great reputation in the Northern Territory. We have strong stakeholder support. We have a strong relationship with the Jawoyn Aboriginal people who are the owners of the land in the project area. Those are all that's our support to lose, and we don't intend on doing that. Perhaps the biggest risk is or area of risk is the same risk that every mining operation in the country faces, and that's attracting and retaining people. The mining industry is a very strong and viable industry in Australia, and competition for labor is fierce. And one of the things that we've done at Mt Todd to try and alleviate some of that is develop and plan for Mt Todd to be a residential project, i.e., having a significant part of our workforce that lives in Catherine or Pine Creek, towns that are within 30 or 40 minutes of the project. That's not a possibility in most operations in Australia. Most operations operate on a fly-in, fly-out basis. And so being able to actually work from a local workforce and hire and train a certain percentage of our workforce will help us to create some stability in that regard. But nonetheless, we'll be competing with a broad number of mining operations to attract and retain people. And that, I suppose that's the single biggest area where the project has risk, but it's a risk that's no different than any other mining operation in Australia.
Yeah, this is also a premature question, but you probably have some feeling for it if regarding the length of the construction period and also commissioning and ramp up.
Yeah, that's actually something that we've spent a lot of time on. One of the, we look at the mining industry and a couple of areas where we've experienced significant cost overruns in our industry is relate to either the development of infrastructure or project development timelines. And with regards to the former, obviously we have a significant amount of infrastructure, and so we don't have to build it, given that we already have paved roads and power lines and things like that. But on the construction timeline, we have adopted a conservative approach. Our engineers, our project engineers, believe that Mt Todd could be built in 18 months. We've allowed 24 months in our planning On top of that, we've added 2 to 4 months for commissioning, and then an additional 2 to 4 months for ramp up. And typically smaller projects ramp up more quickly. That's one advantage to looking at a smaller scale operation and getting things up and running. But we've taken the approach that this is this is not 18 months and turn it on and start producing gold at 100%. Rather this is more likely 24 months, and then over the following 6 months, getting things up to the point that you're meeting completion guarantees with your banks and operating somewhere in the range of 85 to 90% of design capacity. And then the following 6 months, you fine tune it, and you get up to 100 or exceed that.
You say that the project is fully permitted. Are there any ancillary permits remaining to be received prior to starting construction?
Yeah, so the permits we have is what we need to start construction. We would be in a position to serve a letter to the government that said, we've made our formal investment decision and we're going forward with the project. Now, there's no reason for us to do that today, but that's what we could do, is literally start the project within a matter of weeks. Now, there are permits that come about as you begin construction and move forward. The obvious one, for example, is your explosives permits, which is required by Australia. Most countries require an explosives permit. And we'll be using a blasting contractor, and part of their arrangement and part of what they do on normal course is bring the permit from the government. And then, of course, once you get to the point where you've got specific designs, you run those by the local authorities to make sure you're meeting appropriate building codes. But that's a review process, not unlike building a house in most places in the world.
How are your relations with the Jawoyn Aboriginal people?
Yeah, so the Jawoyn have been a very, very good partner. I've described the contractual relationship we have on the royalty, but that agreement that we put in place in 2020 also provided for other elements. For example, we've got commitments to provide opportunities for jobs, training, contracting for either the Jawoyn Association businesses or other businesses that might be Aboriginal-owned businesses. Conversely, the Jawoyn have got a support agreement for us. So to the extent we need their support, we believe they'll be there, and to date, they've been there. All of that is contractual side of it. There's also just the people interaction piece of it, and we've got an exceptional relationship there. We've got a number of people that have worked for us either as employees or contractors over the years that are Aboriginal, and our CEO and 2 members of our local management team meet on a formal basis quarterly with the leadership of the Jawoyn people. And, everything is discussed there, from what's working for us, what's not, what's working for them and not, and how we can participate together to reach our mutual goals. And then, of course, we talk about, potential upcoming job opportunities, what's going on with the project, things like that. So it's a very interactive relationship.
Perfect. And now I would actually like to talk about funding. So I would actually like to run 2 scenarios. Your market cap right now is, when we speak, at least is 85 million US. So scenario number 1, your market cap is 100 million US. And scenario number 2, your market cap is 200 million US. In both these situations, how would you go about funding the construction?
So again, excellent questions. Let's start with the 100 million side of things. And my answer is similar in both cases, but might lead to a different conclusion. So if our market cap is 100 million and we're targeting a capital cost of 400 million, that's a stretch. It's not impossible, but it's a stretch for a company with a $100 million market cap. So we have a couple of lenses that we screen the funding process if we're going to build it or partner it or sell it. Okay. If we're going to build it, we look very carefully at how much equity do we have to issue. And a typical ratio would be 40% equity, 60% debt. And when you start running that through your model, what we really focus on is how does this affect our shareholders on a per share basis, because that's what matters to them. If we issue 300 million shares, of course our market cap goes up, but those extra 300 million shares cause a level of dilution that means the share price might just stay level. We absolutely want to see shareholder shareholder benefit through appreciation of the share price. So dilution of equity is the first consideration. The other lens we look at carefully is what's the impact of the debt or the forms of leverage that you put on. And the theory there is you don't want to load the project up so heavily. Excess debt creates risk in and of itself. And it also steals cash flow away from the company that might be redeployed for things like expansion or might be made available directly to the shareholders in the form of dividends. And we don't want to see such a level of debt that our shareholders' opportunity for benefit from the cash flows of the project are pushed too far out into the future. So those are the key lenses. At $100 million, the dilutive effect is pretty steep, so we're going to be very careful with that. And frankly, that's where things like a joint venture opportunity can take a greater position. You can find yourself in a situation there where the partner coming in has to earn their way in by paying your costs for a period of time. The idea is to get them to largely cover your equity and maybe reduce the amount of debt that you have to put on your remaining share of the project. And they typically pay a premium to your current valuation for that right. So that's something we'll look at. And then occasionally you get a company that's bigger that says, we don't want a partner. So, you have to look at whether there's opportunities that just result in a change of control of the asset. And that again goes back to value. Our shareholders would be giving up the long-term upside, but seeing an initial cash payment. And if it's reflective of what we think is a fair value for the asset, which would not be $100 million, it would be substantially higher, then all those options are on the table. Switching quickly to the 200 million scenario, obviously the dilutive effect and the need for debt can be mitigated to some degree, and that's where you probably shift back stronger towards the opportunity to build it yourself.
You don't mention the stream, despite that Wheaton has a right of first refusal on any stream and royalty on Mt Todd. Is that not in the cards?
Yeah. Oh, it absolutely is. I mean, if we make the decision to go forward with building the project, then we're looking at a number of options. It's still a little bit early because we don't have a financial model for the case we're building right now to put in front of them. But you see Wheaton participate alongside many of the projects. They put up the early money. They have a right similar to what we've given them. And then they would participate alongside lenders. So that's a good option. It's one of those things that stays with the asset, but it's structured so it steps down, like I mentioned. But it allows you very long-term money, which means earlier money is available to shareholders. We've also had early discussions with a group in Australia called the Northern Australia Infrastructure Facility, or NAIF. And they're another group. They provide very low-cost money, typically in the single digits, and they can provide a very long payback period. Commercial banks, private debt groups, they're trying to get in that maybe 4 to 6 year repayment terms. A group like NAIF might, with a project like Mt Todd, I think you could easily see 9 or 10 years on the repayment, maybe longer, because Mt Todd could have a very, very long life at 150 to 200,000 ounces a year. So those are two of the keys that we're looking at. We also have relationships we're building with commercial banks that do project lending on mining projects, as well as private debt groups. And they all have their advantages and disadvantages. But no, I mean, Wheaton very much would be in the mix in terms of places we would look, because they have a history of supporting projects into development.
So I think it would be good to clarify. I mean, are you advancing Mt Todd with intention to sell it or to build and also consequently operate it?
So we believe that the way that we create the most value for Vista shareholders, and I guess that's the principle right there, is that we're looking for value creation. We're not looking for a specific outcome, but we believe that the best way to create value is to form a partnership and develop Mt Todd with a partner. Now, having said that, we're open to a wide variety of different options based on market conditions. We would consider, we recognize that some producers will not want to have a partner. And so we're willing to consider a project level transaction to sell Mt Todd if appropriate value is accorded to the Vista shareholder. If that means that transaction needs to happen at a corporate level, we're open to consider that, provided that there's value creation for Vista shareholders. On the other side of things, we may get to a point and find ourselves in a gold price environment in 6 or 12 months where the market is telling us to build it ourselves. And if that's the case, we are prepared to build the team, go out and hire the team and bring in the people that's needed to begin the work of detailed engineering and design, and ultimately, letting construction contracts and managing construction and putting it into operation ourselves. I mean, I've been in that position. I've done that before as a CEO of the company. That does not concern me. It doesn't worry me. But certainly, we want to act first and foremost in the best interest of our shareholders. That's far more important than me or my team being able to stand there and say, we built a gold mine. We really want to see value creation for our shareholders.
Yeah, when you say that the market would tell you to operate it or build it yourself, are you talking about a specific sort of, if your share price is, twice as high as this today, or what kind of sort of indications?
That's a very interesting question because it will involve a lot of different factors. One will obviously be the gold price and what the market sentiment is with regards to the gold price over the coming, 3 to 5 years. You mentioned, is there a specific share price? Well, certainly where we're at today at roughly 70 cents and a market cap of $85 million, that's not the market cap to go out and raise the money and build the project. If our market cap were double this, would we feel differently about it? Well, certainly. What if our market cap was 3 or 4 times? Well, then it becomes a different conversation. So, but also there's the factor of what do your shareholders want you to do? Where do they want the company to go, and what are they supportive of? And we know that at today's gold price, that Sun Valley is not advocating for development of the project. They think that the gold price is going to go much higher, and that the value of the company and that for them and for other shareholders will be much greater at some point in the future. So, the balance of the rising gold price, what happens with costs, perhaps in the next 2 or 3 years there will be some technological change which will change the economics of Mt Todd. I don't know. There's a number of factors. So we don't have a specific target in mind as to what it would take to make the decision to build it ourselves, but we're continually monitoring market conditions and sentiment in the market, and especially the feelings of our largest shareholders. And right now, that sentiment is, don't be in a hurry to do a bad deal.
So then, say that you would go down a JV path. What kind of companies could be interested in having a JV on Mt Todd?
Yeah, so that's a very broad range, actually. And the purpose of completing the smaller scale feasibility study, targeting 4 to 6 million tons per year is to increase the pool, the universe of companies that would be interested. In completing this new feasibility study, we're not abandoning the idea of Mt Todd being built at a larger scale. That's still there. The work is still valid, but by looking at a project that produces 150 to 200,000 ounces of gold per year, I think that we're increasing the pool of companies that could be interested by perhaps 25 or 30 different companies who would be in a position to write checks that to be a partner in the project. And obviously the Australian mid-tier producers would be the first companies that come to mind. You could say that there's probably another 5 or 10 that mid-tier producers, juniors that might be looking to diversify their portfolios into jurisdictions that are much safer. And so ultimately, I think that the pool size is, without naming names, becomes much larger than it is today, where, the kind of companies that could write, $1 billion checks, if they were of a mind to acquire, a development stage asset, you're looking at the Barricks, the Newmonts, the Kinrosses, the Agnico Eagles, Anglo Gold, Ashanti, Goldfields of the world. Those are the companies that can write those bigger checks today. But having the opportunity to start with an initially, more capital friendly project and then potentially expand it, the number of companies increases significantly.
So say that you choose to build it yourself, or maybe with a partner. We could. Both scenarios are valid. What would be the next steps after you release the feasibility study mid next year?
So an ideal development scenario would be that the gold price continues to rise and increase. We complete the feasibility study. We have a partner. And within months of completing the feasibility study, we conclude a transaction to form a partnership. Let's just say it's a 50-50 deal, and the first thing that we would do as partners would be to undertake detailed engineering that would ultimately lead us to a definitive investment decision. Given the amount of work that's been done on Mt Todd, it certainly would depend on the partner and their willingness to accept the work that's been done to date. If we had a partner who could see the value in the work that's been done without having to recreate it, I would think that within say 8 to 9 months, you could have a detailed engineering completed and firm numbers on a process plant, maybe on the outside a year. And at that point, you would make a definitive investment decision, a construction decision. And fortunately, Mt Todd, literally within a month or two, you could be mobilizing construction crews. The challenge on that would be getting a construction camp built for the construction crews, and there's people who do that all the time. So, that would be the ideal scenario, and what would happen at the conclusion of a feasibility study.
With that in mind, where do you envision Vista Gold in 3 years?
In an ideal world, like we've just described, in 3 years' time, Vista would be nearing the end of a construction period. We'd be beginning to set targets for handover and start of commissioning, and we would be looking at within the next 12 or 18 months, being in a position where we're a very solid mid-tier producer.